Welcome to the 2016 Independent Mortgage Lender Banking Results webinar. I am Nick Ward. I'm a Senior Audit Manager with Richey May, and I'd just like to say thank you for attending today's webinar. I want to go over some housekeeping items with you, introduce our presenter today, and turn it over to Tyler so he can get on with the show. So today's presentation, we will go over the 2016 and the first quarter of 2017's financial and operating results in matrix, as well as discuss what these results tell us about the trends affecting independent lenders across the country. A few things to note before we get started. For those of you seeking CPE credit for this webinar, there will be 4 polling questions during the webinar, as well as a survey that will appear on your screen once the webinar is over. Please make sure that you answer at least 3 of the 4 polling questions in order to qualify for the credit. For those not seeking CPE, you're more than welcome to participate in the polling questions, as well as the survey at the end of the presentation. Certificates of completion for those who qualify for CPE will be distributed in the next few days via email. We have designated time at the end of the presentation to answer any questions you might have related to the topics discussed. Please type your questions into the question box in the webinar dashboard. If we run out of time and are unable to answer your question during the webinar, we will follow up with you directly after the presentation. A recording of today's presentation, as well as the slide deck, will be sent out to all attendees in the next few days. So I would like to introduce our presenter today. Tyler House is a manager here at Richey May in our business advisory service practice. He is responsible for managing the data analytics and business intelligence services offered to the firm's mortgage banking clients. This includes our Richey May Select peer-to-peer benchmarking product. Tyler focuses on adding value to our clients by providing actionable analysis in the areas of financial performance, compensation, budgeting, and market intelligence. He has expertise in pro forma projections, Fannie Mae and NMLS NCR reporting, and chart of account design and consulting. With that, I'll turn it over to Tyler. To start the presentation.
Nick, thanks for that intro, and just all of you who have made it today, thanks for rescheduling with us and having patience there. We were looking at our calendar and we saw that we would be able to add some data, not only look at 2016, but we're also going to look at the first quarter of 2017, a few results there. So that's kind of an added bonus. We actually just released that data on Monday, so it's as fresh as can be, and hopefully you find that as a value add. For today's webinar, we're going to give a little bit more information than we usually do, and that's also kind of in combination because we're also announcing our new benchmarking platform to the industry. We're really excited about it. We've already had great feedback from our current participants in that benchmarking program, and then if we have time today, we're also going to go into a few reports inside the platform at the end of the webinar. That is time permitting, of course. So the new platform, it was built by Loan Vision. If you're unfamiliar with them, their main product is an accounting software that's specific to the mortgage industry. And I just can't recommend those guys enough, just based on our interaction with Loan Vision in building out our platform. Some of the new features will include a much friendlier user interface. Users can look at quarter-over-quarter trends and year-over-year trends easily inside the platform. And then full data sets can be exported with ease, and our quarterly data is actually released now 35 days after quarter end. And like I said earlier, for Q1, we just released it on Monday. So it's a very timely service. For you CFOs and controllers, whose resources are constantly strained by the state auditor of the month, as I like to call it, it's really easy to participate. The data that we collect comes from system automated reports that you really just export and send to us. So this isn't supposed to be a sales pitch webinar, but you really should take a look at our program if you don't already participate. So before we get into the numbers, the meat of the presentation, I just wanted to share a story of the Hawthorne effect. I'm sure many of you have heard it before, but I can't help but share it because I really find it fascinating. Every time I encounter it or hear about it, it's just fascinating every time. So in the 1920s, an electric company in the suburb of Chicago, they decided to do a study. They wanted to better understand, what working conditions are most conducive to the highest levels of productivity among their workforce. So, being an electric company, I guess they decided to focus first on the effect of the brightness of the lighting inside their factory. So they started their experiment by measuring productivity with the normal lighting as displayed on the screen, and they created a baseline. And they measured the current productivity by marking a little X on their chart, and then they turned the lighting down, did the same thing, and measured productivity at the new level of brightness. And what they discovered is that productivity improved with the less bright lights. So they did this again and discovered even less bright lights, productivity was even better. And they did this again and again and again, and they noticed that productivity improved every time until the lighting was so dim that it was impractical to expect anyone to do their job, and the workers became restless. So I just find this so fascinating. It's not necessarily the kind of finding you want if you're an electric company. It might hurt business a little, but nonetheless, it's pretty fascinating. And at the end of the study, what did the electric company conclude? It would be a little bit silly to say that, bright lights hurt productivity, so that's obviously not it. What they did discover is that productivity is improved when employees know they are being measured. Or I like the way, this quote puts it. People will do what management inspects, not necessarily what management expects. That quote's from a book by Dean Spitzer called Transforming Performance Management. So this experiment was instrumental in the birth of, performance management, and it's really these ideas and concepts that are really behind the heart and vision of why we even offer a benchmarking program to our clients. We are seeing, performance management become a norm in most industries, and in terms of the kind of data that can be analyzed and reported on, it's only getting better with advancements in technology. There are also many cost-effective technologies out there like Tableau, who we use internally that make some aspects of data analytics pretty easy. Many of the dashboards on our website were created out of Tableau that allows, accountants like us to create meaningful visualizations without getting expensive developers and programmers involved. At any rate, technologies are making things easier, but performance management, it's much more involved than just looking at metrics, and it's challenging. And we could do an entire webinar on best practices related to performance management alone. But really all that to say is, that Richey May is really devoted to helping our clients utilize performance management. And our benchmarking program is really just a small component of that. And so this leads us into our first poll question around the topic of performance management, or, you could easily call it internal or external benchmarking. So the first question is, how effectively is performance management utilized in your organization? Just remember, you do have to answer 3 to 4 questions to get the CPE credit, or I think you're highly recommended to. And we're going to give maybe 10 more seconds for everyone to answer. All right, almost there. We got 90% of the vote. Oh, okay. Great. This is really interesting. You guys, I guess you can't see the results, but I can. Okay, so 70% or 17%, said no, that performance management is not something you currently utilize in your daily operations. The largest group, 47%, said yes, but it needs improvement, and that's consistent with kind of our experience. What we hear from clients is that everybody's interested, everybody wants to do it, but it's challenging to effectively use it in your organization. I think, even at Richey May, if you have some conversations with Ken, he'd share that, we we face some of these challenges as well. You know, a lot of times trying to align, you know, strategic performance with the metrics that we measure, that's not an easy task. Just under 30% said yes, and it's an integral part of how we manage our company. I think that's great. You know, we are seeing that using performance management as a tool is really really effective if you're able to do it right, and it looks like a couple of us are, and then the rest said I don't know, which is okay. Maybe maybe that's something you want to take a look at further on down the road. Okay. So moving on, here's a couple key measurements that I use when I'm analyzing somebody's performance or doing a peer-to-peer analysis. These are pretty simple. I'm sure most of you are familiar with at least the first two, but I just wanted to talk on a few points here as it relates to measuring your performance with them. So first, basis points, you know, the language of mortgage banking. You know, when we measure basis points, we are using closed production volume as the denominator to get that number. I understand why everyone likes basis points, but I actually much prefer the other measurements on this page when doing a peer-to-peer comparison. It's not that basis points are you know, no good or anything. It's just that the others provide a more apples-to-apples look from one mortgage banker to another when you're specifically doing a peer comparison. Dollars per loan, you know, this is actually my favorite. It's calculated the same way as basis points, except that we're using closed production units or count as the denominator to get those numbers. The reason this is my favorite is because so much of benchmarking is focused on cost analysis, and really most of the cost items that lenders have the greatest ability to influence are incurred on a per loan basis and not necessarily on a volume basis. In fact, one of the major things I always bring up when I'm doing a peer analysis is why can't lenders do the same number of units as their peers when they have similar operating footprints? You know, I think that question should be on everyone's mind, especially when they're doing any external benchmarking, comparing themselves to the industry or to specific peers. The other reason I really like dollars per loan is because when I'm looking at a lender who average loan size varies from the peer group, then their gross margin and basis points always looks off. But when you take it in dollars per loan, they seem to even out or get a little closer. I don't necessarily understand why that is. Only mention it, you know, to the point that it seems that smaller loans require higher note rates in order to generate enough revenue to cover per loan costs of processing, underwriting, and QCing loans. The last measurement on this page, it's probably one that you're, you know, less familiar with. I call it common size. It's basically taking each line item as a percent of total revenue. This measurement also tends to even things out when lenders have different product mix or when lenders have different strategies in the marketplace. For example, we come across some lenders who I would call, you know, cost leaders, and, you know, they produce thin loan margins. And then we have lenders who I would call product differentiation lenders who produce loans with higher margins. A lot of times the thin margin lender is doing mostly conventional, and a lot of times the high margin lender is doing mostly govy, but that rule doesn't always apply. You know, there's some cases where both of those lenders may be doing 50% govy, and they still come up with different pricing or different margins. Usually the lender with thin margin will be paying a fraction of the commissions that the high margin lender is, and when I see that, it's sometimes not helpful to look at this in basis points or dollars per loan. In those cases, it's really good to take the commissions as a percent of revenue, and then you can make your observations, because both lenders really should be coming in around the same metric if they're to be kind of equivalent, you know, around 35% for commissions. So I just want to introduce that, you know, maybe kind of expand your horizons as you guys look at doing benchmarking or comparing yourselves, because I find those last two metrics less used, but I find them very valuable. The first report that I'm going to cover today is what we call the net production income report. This report was designed to compare each lender's core mortgage banking activities and to calculate a per loan profitability that more so resembles their operational performance. Some of the notable items excluded are gains or losses related to unfunded IRLCs, and then gains or losses related to open hedging trades. These items are excluded because they can add some noise to the P&L when you are using closed loans to calculate basis points or dollars per loan. Loan loss provision expense and EPO and EPD, they're also excluded. The reason for this is, there's some noises in these averages when lenders don't record amounts equally throughout the year. And then the other notable items that are excluded are going to be servicing income and expense related to retained MSRs or mortgage servicing rights. So what we're left with is production revenue, net warehouse interest spread, and then cost to originate, which make up the net production income. I really put this slide in, just so when we send out the slide deck that this is for reference. I mentioned most of these items, as why we exclude them. The one thing I didn't mention is that the net production income, that is actually going to tie a little bit more closely to cash flows, and I like that aspect of it. I think cash flows is always a challenge to manage for independents. So here we are, the first chart. Didn't take too long to get here, but we got here. This is the net production income in basis points over the last 13 quarters. I always like to show the historical quarterly periods, as it is helpful to see the context when looking at these numbers. So Q2 and Q3 of 2015 and 2016 were really on par with profits in the second and third quarter of 2012. It also looks like the industry, at least as this chart depicts it, is looking more like a normal purchase-heavy market where it's more predictable that the late spring, summer, and early fall will be very profitable periods, and then the rest of the season will be near break-even periods. Although I know that's not exactly the reality of the industry, because both 2015 and 2016 have been significantly impacted in a good way from high refinance demand. So let's also bring in the production volume trend line so we can compare that to the costs here. I'll just give everybody a second to take a look at that. This is pretty remarkable to me, with that line in there. Just look how much volume has increased. It's even off my chart. So 2016 volume, it was $1 billion higher than 2012 volume. And the volume has really been a significant piece of the overall storyline in the industry. Although there were many challenges in 2015 and 2016, the conditions in the industry have really been very good for independents to scale their business, to spread out increasing compliance costs over greater volume, and to increase their market share. And many independents have done just that without making major M&A deals. On another note, Q1 production levels were as high as they were, or as high as they have ever been in any of the previous Q1s. It was 4% higher than Q1 of 2016, 10% higher than Q1 of 2015, and 19% higher than Q1 of 2013. So, although we recently experienced a drop-off of 30% since the fourth quarter, it's not all bad news. The trend still seems to be continuing, where lenders are still scaling their business. Now I'm going to collapse these bars charts into years so we can see those trends a little bit better. So net production income in 2016, it was on par with 2015 earnings. Both years were very, very similar in terms of the trends that they experienced. Net production for the first quarter of 2017 was 13 basis points, which was just 10 basis points less than last year in Q1 of 2016. It also was 27 basis points less than the net production income during Q4 of 2016. My expectation for 2017 is that net production income will be less than 2016 and likely somewhere in the neighborhood of 40 to 45 basis points on average. The primary reason for this is that we are expecting a decline in overall production volume, which will require lenders to be more diligent about managing and budgeting costs in a shrinking volume environment. The other reasons for less earnings is because there will be more pressure to compress pricing and margins with decreases in volume. And I'm uncertain how the industry will react to that. The last 2 years we've had so much volume that compressing margins to maintain production levels hasn't been an issue. So now I want to break down the components of the net production income report, and we're going to talk a little bit about total production revenue. This is total revenue including the net production income, and here are some of the notable components. Again, the significant revenue pieces that are missing from this are missing from this compared to your consolidated earnings are the gains and losses related to unfunded interest rate lock pipelines, or IRLCs, as well as the gains or losses related to open hedging trades, We also exclude all servicing income. Please do note that we include capitalized mortgage servicing rights, that are included as a core mortgage lending revenue item, because it's an approximate value for the service release premium that could have been earned if those loans were sold with MSR release. I just mentioned that because sometimes people want to put it as a servicing transaction, but for benchmarking purposes, it really should belong as part of your mortgage lending net income or profitability. For net warehouse spread, we are looking at interest income and interest expense for mortgage loans financed by warehouse lines of credit, and then the associated fee expenses for financing those mortgage loans on the warehouse lines of credit. This graph is displaying the total production revenue in dollars per loan. I'm switching gears from basis points to do dollars per loan, really because, like I've said earlier, it's just a better way to look at the expense and revenue components. It's not entirely evident from this chart, but if we put in a linear trend line on this graph, we can see that revenues per loan are increasing. All the way back to Q1 of 2012, per loan revenues averaged just over $7,000 per loan. And then looking at Q1 of 2017, per loan revenues averaged just over $9,000 per loan. If we did this graph in basis points, there would still be a trend that shows total production revenue is increasing, but it would be much more of a slight increase over the same period. And that's really just because the increase in real estate values has driven average loan sizes up, which is also helping increase per loan revenues on a dollar per loan amount. As you can see on this blue line, which is the average loan size, both loan revenues and dollars per loan, and average loan sizes have trended very closely. This chart is still production revenues in dollars per loan, with the time periods collapsed into year-long periods, and then the first quarter of 2017 is outlined in red. From this chart, we can see that 2015 and 2016 per loan revenues increased by $300. 2016 per loan revenues increased by $300 over 2015. In Q1 of 2017, at $9,000 per loan, it was the highest level since we began collecting data for the program. This was actually a little bit of a surprise to see this increase because we heard from a few lenders that they were experiencing margin compression during Q1, although that doesn't seem to be the experience that everyone in the benchmarking program had. Looking at the rest of 2017, I'd expect to see that revenues do see some compression because of pressure to maintain production levels. I would be a little surprised if production revenues for the rest of the year were similar to the first quarter's numbers, but I've been surprised many times before. Next, we're going to talk about cost to originate. Here's a list of the cost components that we cover and report on as part of the cost to originate. Basically for the independent mortgage lender, it's all your personnel costs except servicing personnel. It's most of your operating expenses. And we provide a real good amount of detail which allows our clients to understand, not only if their costs to originate have gotten away from them, but also which categories will they find the most opportunity for improving or cutting costs. Again, here's the historical chart for some perspective on cost to originate. When we calculate cost to originate, we do include a significant portion of fixed costs, as you might have already seen on that last chart, because we really look at your all-in costs, which is what usually creates somewhat of an inverse relationship between production volume and costs. And when we bring in the production volume trend, we can see that a little bit. It's quite noticeable when you look at the low point in volume during Q1 of 2014, and you see how costs have moved opposite to volume. But as we move into 2015 and 2016, the strength of that inverse relationship is weakened. You can see it a little bit in the high points in volume during Q2 of 2015 and Q3 of 2016, where there is little dips in costs. But overall, volume has exploded over the last 2 years, and costs have incrementally increased. That's just conclusive evidence that it is far more expensive to originate a mortgage loan in 2016 and 2017 than it was back in 2012, 2013, and even 2014. When we collapse the cost bars into annual periods, it becomes a little more evident about, how much we're seeing costs rise. In 2016, costs increased about, $350 per loan over levels in 2015. And then in Q1 of 2017, we can see that cost to originate were $1,200 more than the fourth quarter and $800 more than the first quarter of 2016. Looking into the rest of 2017, I expect that costs will show increases of about $200 to $400 per loan. The reason for this is because costs have increased during 2016 and 2015, years when most lenders were maxing out and even exceeding their production capacity in many cases. And then in looking into 2017, all indications are that production levels will be on the decline compared to 2016 levels. Now, most of the increases in costs from 2015 to 2016 were related to increases in personnel costs. Actually, 90% of the increases were personnel related, totaling $353 per loan. Only 4% of the increase was related to increases in operating expenses. So let's take a look at the personnel component costs and what they've increased by. Just give everybody a second, since there's kind of a lot of data on this to kind of catch up and take a look at it. So in this chart, this is basically all the personnel categories that we report on. It's pretty detailed, right? In fact, I'm certain that there's not this kind of cost detail anywhere else in the industry for a benchmarking program. So anyways. In the middle column with all the black numbers, those are the actual costs in dollars per loan for 2016. In the far right column, these are the trends in costs comparing 2016 to 2015. They're red because, as CFOs and controllers, we don't like it when expense goes up, and so I made them red. But anyways, we see that every single cost category has increased. LOs, AEs, and producing sales managers increased by $107 per loan. Most of that increase was driven by higher loan average sizes. Some of the more significant increases were located in the sales support and the admin category, and the secondary QC, post-close, and support category. Not necessarily in the total dollar increase, but if you look at the increase as a percent change from 2015 to 2016, it's pretty significant. Sales support and admin personnel increased by 22%, and secondary QC, post-close, and support personnel increased by 18%. Both of those were the highest percent increases out of all these categories, and the reason that these categories saw increases like this was because these are the groups where the excess staffing caused by TRID was placed. And although TRID was implemented in 2015, the costs weren't fully realized in 2015. Instead, 2016 provides a better picture on the effect of TRID, and in fact, there might even be still some more expense to be realized during 2017, that was caused by TRID. There were also increases in every other personnel category, like I said. A number of factors are driving these increases, and we'll talk about that in a moment. But before I do, it's time for poll question number 2. We're going to get a little personal with this one, have a little fun. That's okay for accountants to do from time to time. But the question is, what is your company's current relationship status with TRID? It's complicated. You're still experiencing issues. It's good, but costing me a fortune. We're over it and have moved on to other things, or I don't know. We'll give everybody 10 seconds or so until most people have had a chance to answer that question. Okay, so it looks like we've got most people to answer. The good news is that 60% of us, we feel like we've moved beyond it. We're on to other things. We're not worrying about it. 6% say we're still complicated, it's still giving us issues. 20% say it's good, but it's costing us quite a bit. 13 said, I don't know. Okay. Well, that's good. I think that is kind of exactly what we expected. We have been hearing that people are still trying to figure out, if they haven't, got the logistics of it down operationally, they're still trying to figure out, from an advertising or from a marketplace standpoint, what's the best way to do it. We've heard of some lenders who have just decided, if they miss that deadline, they're just going to, pay the difference if they have to redisclose anything. We've heard others who, they seem to be not having any issues. They've, made enough changes, and it seems like some of you may be in that boat as well. So hoping that, 2017 doesn't produce or show up too much more in terms of the cost that we're kind of expecting, for TRID to show up in every lender's P&L. Now I wanted to share, a couple things of what we're seeing as the reason for increases in every personnel category that we just looked at. First, over the last few years, with all the added complexities and regulations involving, processing, underwriting, and QCing loans, it's really put a higher price tag on experienced underwriters and other fulfillment personnel who can effectively manage their way through all this and mitigate the compliance risk to the company. So that's driven up wages for these personnel over the years. Also, we've seen a shift in market share where independents are taking over market share that banks held on to. So not only is it requiring more personnel to get loans through production because of compliance, volumes have also increased so much that it's really become necessary for independents to recruit fulfillment and back office personnel from banks and other independents. And this has also driven up wages. So those two components combined with TRID would explain this chart and what we're showing. This chart, it's old, it's from our 2015 salary survey, but it shows how base pay has increased well over the national average increases in base pay for these certain fulfillment and back office departments. For processors and underwriters, we've compiled some preliminary information from our 2016 survey to just show the year-over-year changes in pay. Total compensation has increased by nearly 20% for both positions, and overtime and bonuses increased quite a bit, all of which is driving up those costs. Now on to some increases in operating expenses. As I mentioned earlier, operating expenses made up only 4% of the increase in costs to Originate from 2015 to 2016. And so there isn't much significant to report, except that we are seeing that there is some increased spending on technology. We've observed this trend for the last 6 quarters or so, and we've also been hearing that lenders are motivated to invest in technologies that are going to help improve their operational efficiencies. Efficiencies, I think I got that right the second time around. At $17 per loan, that's an increase of 14% over 2015, which is really right in there with that 18% and 22% increases that we saw in the personnel increases. Looking into 2017, I'd expect to see a larger share of per loan increases related to operating expenses, just because with volumes declining, that the fixed expense component should be on the rise unless there are significant cuts to costs. Now it's time for poll question number 3. And for this question, we're just trying to get a feel for what everybody's feeling. Are they eager to invest in technology? Are we holding off? Or whatever your company's outlook on that is. All right, just maybe 5 to 10 more seconds to get everybody's response. And if you've answered those last 3 questions, I guess you could even skip the 4th, so you got all your 3 of 4 to get your CPE, so it's a good job. All right, so with the results, 44% are looking to make significant investments to improve efficiencies. 37% are just looking to get current technologies up to date for 2017, and then 10% each saying we're not necessarily looking to invest in additional technologies, or I don't know. So interesting. A good portion is looking to get an update or at least improve efficiencies. And the main thing that we're really hearing related to this is that lenders have now kind of at least gotten over the compliance hurdle that it's been for the last couple of years. Volumes haven't swelled up as much, so now executives are able to kind of look at some ways to get back some of that efficiency that we've lost with TRID and other among other things. So moving on, we're going to talk about production and then some other operational metrics, but first I wanted to mention the MBA's mortgage finance forecast. I know many of you are aware of it and use it regularly, but I'm always surprised to hear how many lenders either aren't aware of it or have never used it to help manage their business. Anyways, it's a report that's published monthly by the MBA, and we actually take their report and we put the numbers that they put together and we put it in a dashboard. That dashboard is located on our website, and so feel free to check that out. It may find itself a little bit more useful for those who need something visual instead of just a bunch of numbers on a piece of paper. So their forecast, it's not always in line with what independents experience, and I will admit that the forecasted numbers I'm showing on the screen were very similar to what it was last year around this time, probably a little bit earlier, but around the same time. And things changed drastically. Nonetheless, it's still a good resource that every lender should use to aid internal budgeting and forecasting. You can even just adjust their forecast based on your own purchase or refi mix, so that's helpful. The numbers they publish, it's also what I've used in generating my expectations for 2017 that I've shared in today's webinar. And as you can see on the screen, the MBA is forecasting that the industry as a whole will see a decrease of 16% for 2017 over 2016 levels, and that breaks down to plus 9% for purchase business and a minus 43% for refi business. Using these numbers and the approximate mix of the lenders who participate in the benchmarking program, I would probably adjust them down, as I would expect that production levels will decrease more like 11 or 10%, and that's just because independents or most of the lenders that do the benchmarking program are a little bit more purchase business focused. On to production. We've seen various charts on production already. This one is in annual figures for production volume, and I just find it amazing that from 2014 to 2015 and from 2015 to 2016, production and volume increased by about 660 million in each of those years. That's pretty significant considering the total increase in both of those years is almost equal to the total production in all of 2014. For Q1 of 2017, production volume was down by 30%, and actually this chart's a little inaccurate. That should be for all of 2017. We basically annualized the 11% decrease, so my mistake there. Hopefully we'll get that corrected before we send that out. Anyways, for Q1 of 2017, production volume was down by 30%. It is up 4% compared to volume during Q1 of 2016. As I mentioned earlier, I think that most independents will see a decrease in production volume of about 11%, but again, that's depending on how focused on purchase business each lender is. And now we've gotten to our final poll question for the day. Even if you answered all the previous three, we'd appreciate an answer here. Very interested to hear what you guys have to say for this one. But really, we're just interested on what's your expectations for production volume for 2017 relative to 2016 levels? All right, maybe just 5 more seconds. Almost got everybody. while we're closing it up, we actually had a question in, and please feel free to share questions anytime they come up. If we can, we'll address them on the spot. Otherwise, we'll address them at the end. But somebody asked, what portion of originations are done by independent mortgage banks versus depository banks? So our benchmarking program, it's actually, we only work with independents. There might be a few instances, maybe one or two, where we have a division of a bank who just operates, completely separate from a depository, and they're included in the program. Otherwise, it's pretty much solely independent. So 100% for the data that we're sharing today. But I guess as I was reading that question, it might also be kind of around market share for the industry as a whole. So actually, for 2015, when the HMDA data came out, that was the first time that we saw independents overtake depository banks as a whole in terms of who has the most share. It was really close, but just a few percentage points where independents overtook them. And I think based on some kind of preliminary other data sources, it looks like independents have continued that trend, not as much as we saw in 2014 and 2015, but I think that gap has grown a little bit for the industry as a whole. Okay, so now back to the question. Okay, interesting. A lot of mix here. So 40% or just under 40%, they're expecting production levels less than 2016. 23% are saying it's going to be on par with 2016. The largest group, 35%, which we typically expect from independents. They tend to be pretty optimistic, kind of like salespeople. They're expecting higher levels in 2016, and that's 35% of the group. And then just 5 have said, I don't know. So very interesting. I think a lot of times everybody wants to increase market share. It's not mathematically possible, but I think that's how independents are successful in managing their business, because they go after that pretty aggressively. Okay. Next topic, I want to talk about production units, specifically break-even analysis. As part of our benchmarking program, we do a basic break-even calculation and analysis. Internally, you should have one that's much more robust, but this tends to be pretty good as a peer comparison. For contribution margin, also often referred to as the net margin, we take production revenue minus all sales personnel costs to originate, or CTOs. For fixed costs, we use cost to originate, all the items except for the sales personnel. And like I said, it's basic. There's a lot of small variable cost components mixed in with the fixed cost, and so it's not perfect by any means, but I think it's a pretty okay metric in terms of using it for peer-to-peer comparisons. So as you can see from the chart, break-even units have increased each year since 2014. And this just tells me that record high production levels weren't driven alone by favorable rates and favorable market conditions, but instead companies have also pursued organic growth, or they've increased their footprint or their operations. And like as a side note, I would say most all of them in the program have done it without major M&A deals. Now, from 2014 to 2015, break-even units increased by 670 loans. From 2015 to 2016, by just over 1,400 loans. And then looking at 2017, assuming about 11% decrease in volume, I'd expect to see a break-even, surplus, or percent over the break-even amount in terms of units originated to be 25% instead of 37 and 38% that we saw in 2015 and 2016. And by the way, the surplus figure, that's really just the number of units above and beyond the break-even. That's really where you begin to make money instead of lose money. All right, now let's talk about loans per FTE. FTE, just full-time equivalent, which basically means we're calculating the average time somebody's employed during the period and assigning somebody who's been there the full year as 1, somebody who's been there for the half year as 0.5. 2016, it was really the most efficient year at over 2 loans per FTE per month for all the employees, or all the origination-related employees. And when I hear that really just begs the question: if it was so efficient, how come costs increased for every personnel category? those two items usually don't go hand in hand. But it comes down to, a slide that we did earlier, that the increased demand due to regulation and complexity has driven base pay up. And then because of massive volumes, lenders were more likely not to hire more people, and instead they decided to pay out big overtime amounts and large bonuses to those fulfillment people who were covering the gaps. Looking at this same chart, but volume per FTE instead of units, we see the same trend, only more so, that we saw on the previous chart. Higher efficiency in every personnel group except the secondary QC post-closing and support group, which, as we had identified earlier, was really just because that's where a lot of the TRID staff was kind of placed in terms of coping with the transition and coping with kind of the additional workload. Now let's take a look at the workforce mix among these departments, and we'll see that the sales support and admin group and the secondary QC, post-closing, and support group have been making up a greater percent of the workforce each year as we move along. And then interestingly, LOs and AEs and producing sales managers have seen a pretty significant decrease. I don't know what's driving that trend, so I'm happy to get any input from the audience if anybody has some insights on those items. All right, so another topic that is top of mind or we're hearing a lot of discussion about is independence and servicing. So this chart we're looking at in the top line, it's just the number or the percent of lenders in the program who are retaining MSRs, and they have to be retaining at least 100 million. If it's less than that, we're kind of considering them that they're not really servicing, they're just kind of dabbling a little bit. So we can see that this trend has grown. Back in 2012, it was only half the lenders, but as we move along, we reach a high at 80% in 2015, and then we've actually seen a little bit of a reversal in that trend in terms of who is retaining, and I think mostly that's because servicing is a business that's hard on cash flow. Mostly the lenders that we see who do well with it are lenders who have high margin and they don't need that SRP for cash flow, and they can kind of delay that a little bit. The other thing I would say is lenders who are successful in servicing, it's really a big or important piece of their strategic plan. The numbers are tight for it to make economic sense, and we've kind of experienced that over the last couple of years. Although I think that the big idea now is that now that rates seem to be moving upward, or we're really anticipating that they will be moving upward soon, that the servicing values are going to go up, in the life of those loans, and the MSR portfolio should last a little bit longer. The next line, we're looking at percent of portfolios that are valued at fair value. And, it's not necessarily a clear trend here, but that number has really ranged between 50 and 60% over the last time period. And then at the bottom, we just have listed the valuations in basis points for portfolios at fair value versus lower of cost or market. Okay, so we have 10 minutes left. I'm going to kind of cruise through the last slides. I would like to get into the platform to show you a few things, so bear with me. Let's see here. At the end of 2016, lenders' servicing portfolio averaged nearly $2.5 billion, which was really just below the average production volume for all of 2016, which that's important. A lot of times we hear about the idea of servicing portfolios being a hedge to when rates, negatively impact production. And so, now that it's leveraged closer to the annual production level, that's going to have more of an impact on those lenders who do have servicing portfolios. At the end of Q1 of 2017, we saw that portfolios actually decreased on average, and that was because of a few sales, and fewer lenders were retaining just because, bottom lines were hit hard and production was hit hard. For 2017, I'd expect that, portfolios are going to increase, especially during Q2 and Q3 when production levels should come back, and it should, surpass the $2.5 billion that we saw in 2016. Equity, the figure we use is adjusted tangible net worth. It's really basic. It's just taking equity. We pull out goodwill and related party receivables. It's increased almost 70% since 2014, which is pretty remarkable, and it really just goes to show that the industry conditions, although they've been challenging and filled with compliance risk, compliance issues, and complexities, they really have allowed for lenders to scale their business, to build up capital, and like I said, to spread those increased costs over greater volumes. And just over this time period, it's been fairly consistent that lenders are retaining about 55% of earnings to capital. Return on equity, 2015 and 2016 post really strong returns at 41% and 38% respectively. We think that this is going to attract a lot of private equity. I think a lot of other firms are seeing that the mortgage industry can be profitable, and so that's going to probably bring on some competition. In Q1 of 2017, there's an annualized return of 6%. That's typical of seasonal trends for Q1. Last year, at 2016, there was a return of 9%. For the rest of the year, I'd expect that returns will get a little bit better, probably show up between 20 and 30% on average, not nearly as high as 2016, unless lenders decide to scale back capital. So that's all the slides that we have today. We are going to go, since we have a little bit of time, to get into the platform itself. And now is a great time, while I'm kind of switching gears, to insert some questions. And I think we actually have a few that I might address right here. Okay. So we had a question about why include capitalized MSR and net production income? Isn't it unearned revenue? So the reason we do this, ideally, the capitalized MSR, it should be the fair value at the time you capitalize it, and that should be relatively close to the SRP. If we excluded it from the results, then lenders who were retaining MSRs, their performance would look bad, or it would look worse than the other lenders. So we do break it out because I think it's important to be aware of it, so you can kind of see what percentage of the revenue is kind of unearned or is an estimate. It's not kind of realized. But for peer-to-peer analysis, you got to have it there because it's kind of a replacement of that service release premium. The channel mix of the participants in our data, somebody asked that question. Most of it's retail, but we do have a significant number of lenders who have large wholesale channels and direct-to-consumer channels. We actually break that out in our program, and we're going to try to get into the program so we can see some of that, and I'll break out the channels.
Well, Tyler, switching gears, we will be sending out the slide deck to all participants. You will receive that in an email in a day or two. If you do not, please reach out. We will make sure you get that. As you know, there's still some follow-up questions related to depository versus independent market share and product mix. Where I've seen that comes out at the end of the year, usually at the Accounting and Finance Conference that the MBA does. I'm sure they do it at their national. So I've seen it from the MBA. If you are still interested in those figures, please reach out and I can get you the slides I have access to. And with that, I saw an interesting article that related to JP Morgan Chase, that they were going to offer 100,000 reward points to people that close a loan with them during the summer. So I think, that's something to be aware of. Is it seems like maybe some of the depositories are going to start to get an appetite for some of this market share and see what they can do to take it back.
Yeah, and then Nick, to add to that, we also do, we analyze the HMDA data. We have a dashboard on our webpage with the HMDA data in there, and it has precise market share data. The bummer about that data is it's so old because I don't know what it takes to get it together. Everybody's having to report by March 31 of the previous year, but for whatever reason, the CFPB takes a lot of time in scrubbing it, so it's pretty accurate data. That comes out usually in October of the following year, so look for that on our website. Right now, our dashboard is free of charge. We haven't decided if we're going to continue to do that, but that's really a great resource if you have any market questions, because you can look at very specific markets. You can look at the entire nation as a whole. You could even, drill down as far as the metro area. So take a look at that. In fact, we can even include that link on an email so you guys have that or know exactly where to go. But anyways, we had another question before I kind of move on. I had a question about how many participants are in the survey in total. So we have about 60 lenders who participate in the program, and we're continuing to grow that constantly. So probably next time you see us, we'll hopefully be around 80 next time this year, or maybe even 100 if we can get some of you guys to join. But right now I'm actually in the platform itself. This is the platform. It's really easy to use. Basically, when you come in here and you are going to, you know what, I'm sorry, I actually need to do something to set up here. There we go. So this is the home page. We have a number of ways to interact, but basically here's where you come and you have access to all these different peer groups. In general, we break them down by origination channel and then by size, and then we have a couple others. For today, I'm going to pull up Retail Complete. We'll look at Wholesale Mix Complete, which is just our lenders with significant wholesale channels, and then we'll look at Direct Consumer Complete. And then you have access to all the different time periods that are in here. I'll just look at Q1 of 2017, and please know this is information that we typically don't share, so this is a special benefit to you guys, for you who don't participate in the program. But after I've done that, it's pretty simple. You just click on Go to Reports, and then this is going to give us a report of all the different origination channels. So I got Wholesale Mix Complete on the left, Direct to Consumer in the middle, and then Retail. And I might make this a little bit bigger because it seems to be shrunken. And here's that net production report that we were just talking about. And so when we kind of scroll down to the costs, you can see that the different channels have fared differently. With wholesale, near break even, or actually just a little bit below break even. Direct to consumer actually with the best quarter, and I think that would probably be due to some trailing refi at the end of the year. Everybody, as they saw rates go up, wanted to get in while they still could, and then retail showing up at 21 basis points. So this is really great because you can see a lot of the differences in the models. I'll point this one out. The biggest difference between direct consumer and retail, traditional retail, is this marketing expense, where we see heavy spending in marketing and advertising to generate leads, and then the difference is also found up in the LOs, where these LOs in the direct consumer channels, they're not expected to generate as many leads as in traditional retail, and so that's kind of the makeup of the difference right there. Like we did in or talked about in our report, or in the webinar today, all these reports can be you can change the metric. Right now we're looking at it in basis points. You can look at it in dollars per loan with quite a bit of ease. You can look at common size, like we also talked about, or you can take this amount, which we're looking at amounts, and you can change it to a trend, so you can just see what the trends are quarter over quarter or year over year. And so I'm just going to probably rest on this page, just give everybody a chance to take a look at it and to maybe see, how or compare how they've been doing to the other peer groups here. Again, this one we're looking at is in dollars per loan. And we'll scroll down to some of the costs. And like I mentioned earlier, we really capture a lot of detail in terms of personnel categories. I don't think that there's anything out there in the industry that's this detailed for personnel costs for mortgage lenders. And we'll go down to net income. So it's a rough quarter in terms of net income compared to last year. We did have a question on product mix. And so I thought I would show this report as well so that you can all see what the kind of product mix looks like for these lenders. So like most independents, we're typically pretty heavy in government loans. That's why we have better margins than the banks. That's where we really own that market. And then you can see here's kind of the breakout for wholesale. these lenders typically have a mix of retail and wholesale. Direct to consumer, they also typically have a mix of retail, and then our retail group is virtually, 100% retail, with a few who have less than 5% of wholesale. We'll go to a ratios report as well, and I'll just scroll through these fairly quickly so you guys can just get a glance, because I know we're just about beyond time. But that's really all I wanted to show you. I'd be happy to get on a call or set up a quick demo so you guys could see it for yourselves and discuss, how this might be of value to your organization. Otherwise, do we have any additional questions? No more additional questions. Again, you can always send those directly to me or to someone else at Richey May, and we'll get those answered offline. I want to thank you guys for your attendance today. I hope it was meaningful for you guys. We always enjoy adding value to our clients and potential clients through the benchmarking data of our benchmarking program. So thank you.